You've Got This, Managing Your Student Loans by Texas A&M University, Kingsville, Title V, I-CARE Grant. This presentation provides a review of available repayment options for federal student loans. You'll also learn about your loan responsibilities and decisions you make that can affect successful repayment of your federal loans. This material is not intended to constitute any tax, investment, or legal advice. If you need investment, legal, tax advice, and/or credit counseling, please consult with a professional within those areas. Today we'll cover what kind of repayment options are available to you as a student loan borrower, and other options to help you out when you're having trouble making your student loan payments. We'll also highlight some important points in your life that could affect your federal student loans. Have you checked recently to see how much you owe in student loans? If so, were you surprised? Borrowing money to pay for your education can greatly impact your quality of life today and after you graduate, but it can be scary to think about how much you've borrowed. So we're here today to help you understand how your loans work and all of the options available to make repayment as painless as possible. Taking out a loan may help you meet your college expenses without working too much while in school. Federal student loans, which are borrowed through your school, even give you the option to delay repayment until after you graduate. They are also generally less costly than private education loans, which are borrowed from a bank or credit union. That is why it's important to take private education loans only as a last resort. Federal student loans should be your first option if you need to borrow money. Another thing worth noting about borrowing is that consistent repayment of a student loan begins building your credit history, which can help you later in life to buy a house, purchase a car, and even get the job you want. There's another side to it though. Not managing your loans well can have a negative impact on your life, hurting your credit and causing other consequences. Repayment plans. When you begin paying back your federal student loans, you will have a number of repayment plan options. Most are available to all borrowers, while others have specific criteria to qualify. Selecting the right plan is very important, and you owe it to yourself to spend some time thinking about this carefully. When you first go into repayment, your loan servicer, the company that handles the billing and paperwork for your loans, will most likely place you on the standard repayment plan unless you request a different plan. But keep in mind that you have the right to change repayment plans at any time. Federal student loan borrowers may choose from a variety of plans, falling into two broad categories, including traditional plans and income-driven plans. We'll start with the traditional plans that have been around for a long time and are available to almost all borrowers. The standard repayment plan is the least expensive option. That's because, compared to the other plans, you pay less in interest, which lowers the total amount that you pay over the life of the loan. For example, a $10,000 student loan paid under another repayment plan will cost more overall than an equal loan paid under the standard plan. With the standard plan, when you enter repayment, you receive a repayment schedule with a fixed monthly payment that will allow you to repay your loan within 10 years. The payments themselves are higher than under other plans, but by repaying the loan more quickly, you lower the total amount you repay. The graduated plan allows you to make smaller payments at the beginning of your loan term. The payment amount gradually increases over time, usually every 2 years, so that your loan will still be repaid within 10 years. Comparing apples to apples, on a $10,000 student loan, the total amount paid in interest under a graduated plan will be greater than it would be under the standard repayment plan. But the payment structure allows you to make smaller ones at first, while you're getting established in your career. The extended repayment plan is available if you owe at least $30,000 in federal student loans. Under this plan, you repay your loan over a period of 12 to 25 years, depending on whether your payments are fixed or graduated. Also, in comparison to the standard repayment plan, your payments will be smaller. However, since you will make payments for a longer period, you will pay more interest over the life of the loan. Income-driven plans are, for the most part, newer repayment options. They can give you more flexibility in repayment. These plans include income-based, income-contingent, pay-as-you-earn, and revised pay-as-you-earn. All of these plans have something in common. They allow for your monthly loan payment amount to be based on factors unique to you, such as your income, your family size, or the amount of loan debt you have. There are a few important things we want to emphasize today. Because these plans are based on your unique circumstances, your loan servicer has to make sure on a regular basis that your payment amount is still appropriate, so your eligibility is reevaluated every year, which means your monthly payments may change as your income and other factors change. You'll have to complete a certification form each year. In most cases, you will pay more in interest because your repayment term will be extended over 20 to 25 years, unless you are able to repay it off earlier. If your loan is not paid off after you've made 20 to 25 years worth of qualifying payments, any outstanding interest and principal will be forgiven. However, be aware that the amount forgiven under this program may be taxable. Be sure to consult a tax professional if and when this applies to you. In an ideal world, college graduates would all find great jobs immediately. However, in today's job market, it may take some time to find a job that meets your expectations and financial needs. If that process takes longer than 6 months, your student loans may come due before you have much of an income. Or maybe you find your dream job, but then your company downsizes. Other complications can arise. What if you find, for example, the exact teaching job you have been preparing for, and then realize that teaching is not for you, and you'd like to go back to school to study something else? Getting married or having a child can also create financial changes that can throw your budget off, despite your best laid plans. These type of situations can lead to financial hardships, because you still owe your student loan, even if you don't find a job or decide to switch professions. In situations like these, the worst decision that you can make is to avoid making arrangements to repay your student loans. Options. Your loan debt will not go away because you decide to ignore it. In fact, the debt could grow quickly. If you're having trouble paying, you have much better options than hoping it disappears. First, think about switching to a different repayment plan. Maybe standard or graduated repayment was working for you, but now you need more flexibility in your monthly payment. Go to studentloans.gov and try out the repayment estimator to see if you qualify for an income-driven repayment plan instead. But besides the different repayment plans we discussed, you may also seek deferment or forbearance. These options can help you avoid defaulting on your student loan, especially in the short term. You also have forgiveness and discharge options in some cases. Generally, forgiveness is available to people who work in certain teaching positions or in a public service field, while discharge may be available due to certain circumstances that are generally beyond your control. Deferment allows you to postpone a payment if, for example, you are experiencing economic hardship or are unemployed, in graduate school, or are in the military. In the case of subsidized loans, deferments provide a great benefit. The government pays the interest that accrues during the deferment period. A deferment is an entitlement, meaning if you qualify, you will be granted one. Your eligibility will depend on the type of loan you borrowed and when you first borrowed a federal student loan. Your loan servicer can determine your eligibility once you have submitted all the documentation. To request a deferment, contact your loan servicer. Many times you can download the forms from their website or apply online. Not sure how to contact your loan servicer or who your loan servicer even is? Log on to the National Student Loan Data System, NSLDS, to get the name of your servicer for your specific federal student loans. You may also contact your institution's financial aid office at the link and number provided. Forbearance allows you to postpone or reduce your payments for an approved period of time. However, interest will continue to accrue while your loan is in forbearance, regardless of whether the loan is subsidized or unsubsidized. If you are eligible, a deferment is usually a better option than a forbearance because, as we mentioned earlier, the government pays accruing interest for subsidized loans in the case of a deferment. Also, forbearances are generally not entitlements. Often, it will be up to your loan servicer to decide whether or not to grant one. You may request a forbearance from your loan servicer, but remember to ask if you qualify for a deferment first. Under the Teacher Loan Forgiveness Program, up to $5,000 or $17,500 for secondary math or science or elementary or secondary SE teachers of loans may be canceled for teaching over a 5-year period in a school that serves low-income students. The Public Service Loan Forgiveness Program was created to encourage individuals to enter and continue to work full-time in public service jobs. Under this forgiveness program, any outstanding balance of principal and accrued interest is forgiven after the borrower makes 120 monthly payments while working in a qualifying job. In certain cases, a borrower may qualify to have his or her loan, or a portion of the loan, discharged due to certain circumstances that are generally beyond the borrower's control, such as total and permanent disability. Other circumstances that may qualify for discharge include death, identity theft, or if your school closes. Now let's talk about some other options that are available to you. Once you get ready to start paying on your loans, you have the option to combine your federal student loans into one loan. This new consolidation loan will have a new fixed interest rate that is calculated by taking the weighted average of the interest rates of all of your qualifying federal student loans. There are a few things to think about before deciding to consolidate your loans. First, keep in mind that you will likely pay more in interest because consolidation lengthens your repayment term up to 30 years. Also, if you include another kind of federal student loan called a Perkins loan in the consolidation loan, you will lose the special benefits that come with a Perkins loan, like cancellation and extended deferment options. Know that there is no fee for consolidating your federal student loans, so never pay a company or individual for completing the application on your behalf. You will learn more about loan consolidation in your exit counseling session. Other options that are available to you and your families are tax deductions and credits. These deductions and credits can help offset the amount of taxes you and/or your parents pay. For instance, you can take a tax deduction for the interest paid on student loans. This benefit applies to all loans used to pay for higher education expenses, even private education loans. Also, a deduction can also be taken for the tuition and fees that you pay. Additionally, there are 2 tax credits that can help offset your costs for tuition, fees, books, and supplies. These credits include the American Opportunity Credit and the Lifetime Learning Credit. You can learn more about these credits by visiting the Internal Revenue Service (IRS) website at www.irs.gov. Important transitions. Now let's move on to talk about changes in your life that could affect your federal student loans. Sometimes, due to unforeseen situations in our life, we must make changes to our class schedule or graduation plans. While we cannot avoid unforeseen situations, we can certainly prepare so that we stay on track with our education and avoid defaulting on our student loans. Here are some examples of changes about which you should contact the appropriate offices at your school along with your loan servicer. Changes in personal information. When you move to another location or change your email or phone number, you must notify your school's financial aid office and your loan servicer. That's so correspondence regarding your loan will reach you. Otherwise, you may not know when your first payment is due and your loan may become delinquent. Dropping or adding classes. One of the requirements of your federal student loan is that you be enrolled at least half-time. Dropping or adding classes can change your enrollment status. For example, if you drop below half-time, your loan will go into repayment, generally within 6 months of the date you drop below half-time. You may not have enough income to begin making payments yet. Consult with your financial aid office if this happens. Changing graduation date. Some decisions that could affect your graduation date include changing majors, pursuing a double major, or studying abroad. Decisions like this can result in additional expenses that might require you to borrow more money. Be mindful of the additional debt you may incur and the purpose for which you are borrowing. Withdrawing from school. Consult with your academic advisor and your financial aid advisor before you withdraw from school. Stopping classes without notifying the financial aid office can seriously affect your student loan. Learn more about timeframes and attend an exit counseling session. This way, you'll minimize the probability of loan delinquency and default. It's also a good idea to visit your academic advisor to avoid lost credit for work completed. Transferring schools. If you transfer to a different school, consider the amount of money that you already borrowed at your current college. There are borrowing limits under the Federal Student Loan Program. Loan limits are per borrower, not per school, and this affects how much you can borrow for your overall school expenses. Again, consult with your financial aid and academic advisors. Paying interest on your loan. When you take out a federal student loan, pay attention to the type of loan that you take out, and especially the total expected interest accrual. For instance, there is a major difference between a subsidized and an unsubsidized loan. For subsidized loans, the federal government will pay the interest on the loan while you are enrolled at least half-time in school. However, if you do not qualify for a subsidized loan and take out an unsubsidized direct loan, you are responsible for the interest that accrues on the loan while you're enrolled. While you have the option to defer its payment, you may want to seriously consider paying the interest while you are in school because you'll avoid the interest accrual. Attending exit counseling. One of your borrower responsibilities is to attend an exit counseling session before you graduate or drop below half-time enrollment. These sessions provide key information about repayment plans, loan forgiveness programs, and some debt management resources that can help you manage your loan. Failing to attend means that you'll know less about available resources and may even result in your school withholding your transcript or degree until you complete a session. NSLDS can help you keep track of your federal loans and provide you with pertinent information such as amounts, loan types, loan servicers, and much more. The Federal Student Aid website contains a wealth of information pertaining to the repayment of your student loans. Loan calculators are available for calculating payments under each repayment plan. You can also go to www.studentloans.gov to request the income-based repayment plans, including IBR, ICR, Pay-As-You-Earn, and Revised Pay-As-You-Earn. And your institution's financial aid office is always available to answer questions.